On September 16, 1992, a day that shook the financial world, George Soros made a staggering $1 billion in just a few hours. This trade, often hailed as a masterstroke in financial history, didn't just make headlines, it sparked controversy and debate. But were Soros and his team actually responsible for breaking the bank, or is there more to the story? Today, we're going to delve into the intricate details. How did George and his team orchestrate such a monumental feat? What can you learn from this trade to make more money in the markets? And did they truly break the Bank of England? Before we understand the trade, we need to understand the setup. This means understanding the European monetary system, the EMS, and its central component, the exchange rate mechanism, or ERM. The origins of the EMS can be traced back to 1960 when the heads of the member states of the European Economic Community met in The Hague and agreed to move towards the goal of a single European economy. In 1970, Prime Minister of Luxembourg, Pierre Werner, produced the Werner Report outlining the structure of the EMS, or European Monetary System, and moving toward the goal in 3 stages, with the ultimate goal of pegging the currencies together to make cross-border transactions easier to theoretically usher in new levels of peace. In 1972, the European Economic Community currencies were pegged to each other in a scheme called the snake in the tunnel, which created a single currency band combining the currencies together, akin to rock climbers hooking together for safety while they move across rocky terrain. This slithery ERM did make it easier to transact across borders and paved the way for a single European currency, but it put pressure on each country's central bank and collapsed a year later. When there are lots of transactions selling one currency for another, it pushes the sold currency's price down and increases the purchased currency's price. Supply and demand mechanics work for currencies just as they do for goods, but with the ERM there was a catch. If a currency's price moved outside the agreed upon bands, the central bank would need to keep the currency within the bands by buying when the currency fell or selling when it moved too much above the band. And this requirement to keep the currencies within the snake, as we soon will see, sowed the seeds of destruction. But first, a little political drama. European currency exchange rate stability was one of the most important objectives for policymakers since the Second World War. The desire led for leaders of Germany and France to successfully champion the EMS on December 5, 1978. France, Denmark, Belgium, Luxembourg, Ireland, Netherlands, Germany, and Italy's currencies formed the snake once again. And even though there was no formal anchor, the German central bank and the Deutsche Mark stabilized the so-called snake. The UK didn't join the party as Prime Minister Margaret Thatcher feared history might repeat itself, but of course this time's different, right? But due to poor economic conditions, she caved. A few months after joining the ERM, she resigned, and Chancellor John Major, who championed the ERM and held positions beneath Margaret, came to power. It was done. The UK entered the ERM in October 1990, agreeing to join with a fluctuation band of 6%. At entry, the pound sterling had 15% inflation, 3 times the rate of Germany, and low labor productivity. But joining House Slytherin wasn't a magic bullet. Over the next 2 years, the economic climate in the UK went from bad to worse as the economy continued to shrink with an inverted yield curve. Typically, when an economy is in recession, central banks will cut rates, making borrowing easier. The cheaper debt helps fuel growth. But since they had to maintain their currency exchange rate, they couldn't do this. And on the other end of the snake, again, Germany being the anchor, kept interest rates high, so demand for its currency stayed high. And if this wasn't bad enough, the UK had double deficits. The government was spending more than it was making from taxes, and it was also spending more on trade than it was earning. All of these factors weakened demand for the pound over time, forcing the UK central bank to forego its foreign currency reserves and buy its own currency. The writing was on the wall, setting up one of the greatest trades in history. Starting in August 1992, Druckenmiller and Soros began building a position. The trade thesis was simple: the snake in the tunnel was unsustainable and the artificial demand from the central banks would eventually break. They started shorting the pound and the Italian lira. They would borrow these currencies from the banks to buy German marks while paying interest. The idea is that when the ERM broke, the currencies would drop relative to German marks and they would buy back the currencies at a discount, earning the difference minus interest paid as profit. But understand that George and Stanley are pushing serious cash around and that slippage can be massive. To reduce the liquidity risk and leverage returns, they used the marks to buy German and French bonds while simultaneously purchasing equities in weak currencies and selling short equities in strong currencies. Let's break this down. Bonds in strong currencies move up in a flight to safety, assuming no deleveraging effects. The rationale behind bonds is simple. The underlying currency is strong and bonds add additional yield on top. Stocks do the opposite, and it's a little more nuanced. When a currency falls, stocks in that currency move up. The reason is due to something called purchasing power or parity. If you think about it, it makes no sense for Tesla's value to drop just because the value of the US dollar plummets. Tesla is priced at what the market thinks it is worth, irrespective of currency. Now, don't get me wrong, this isn't to say that a weak currency over time can't be bad for business, it can. But the opposite is also a hidden gem. Finding companies in weak countries where most of their revenue comes from strong currencies is that hidden gem, but I digress. Let's get back to the bombshell catalyst for this $10 billion trade. In early September, the president of the Bundesbank, Helmut Schlesinger, spoke privately in an interview with the Wall Street Journal, where he stated that he believes some currencies might come under pressure. What Helmut didn't know, allegedly, is that he was being recorded and his story was ready for publication, but more on that in a second. On the 13th of September, Germany cut interest rates by 0.25% or 25 basis points, causing the Italian lira to drop by 7% in response. This massive asymmetric move made the untenable relationship between the German marks and the weaker ERM currencies crystal clear. On the evening of Tuesday, September 15, 1992, Helmut's bombshell interview was published. This was the catalyst Druckenmiller and Soros needed. George is on record stating that Bundesbank was basically egging the speculators to speculate against the weaker currencies, and he took the cue from this article. And when Druckenmiller told Soros that he was going 100% short of the fund on the British pound against the Deutsche Mark, George was pissed. He said, "When you have tremendous conviction on a trade, you have to go for the jugular." George thought this was a once-in-a-lifetime opportunity and that Druckenmiller should be short 200% of the fund. And Druckenmiller states that this was the greatest lesson he ever learned from Soros. What separates average investors from super investors is their ability to make big bets when they think that they are right. If George and Stanley lose, they stand to lose very little. But if they win, they stand to win big. And this is a perfect example of an asymmetric bet. But can't the Bank of England just stop accepting orders to sell pounds, preventing its currency from freefall? Well, no. And this is why the snake is so apt. The ERM required the Bank of England to accept any offers to sell pounds. So when trading began, sell orders came in like an avalanche. To prevent the collapse, Chancellor Norman Lamont and Robert Lee Pemberton, Governor of the Bank of England, smashed the buy button. They began by buying £300 million twice before 8:30 a.m., but to little effect. Around 10:30 a.m. on September 16th, 2 hours later, the British government made a fatal mistake. They announced an increase in the base rate from 10% to 12% to tempt speculators to buy pounds and cost the short sellers money. Their thought process was that increased interest rates would hurt short sellers borrowing the currency due to the interest expense and cause interest from others reaching for higher yields. As selling continued, they increased base rates from 12% to 15%, but it only added fuel to the fire. Their move backfired. It was clearly seen by the markets for what it was, an act of desperation. After all, when your economy is in recession, you reduce rates to spur growth. You don't invite a depression by increasing your rates by 15%. Traders smelled blood. They dumped pounds as fast as they could, but this time spook businesses started liquidating too. By 7 p.m. that evening, Lamont announced Britain would leave the ERM and rates would remain at the new level of 12%. However, on the next day, interest rates came back down to 10%. What a day! This September 16, 1992 is forever known as Black Wednesday. The currency eventually devalued by around 20%, making short sellers a fortune, especially for George and Stanley, who had the foresight to see the inevitable and bet big. And by big, I mean $10 billion big on equity of $7 billion. In other words, for every dollar in equity, they borrowed 43 cents to make a $1.43 position. Now that's going for the jugular. But was it really George and Stanley's bite that had defeated the Bank of England? I'm not so sure. The daily turnover in exchange markets in the early 1990s was typically over $1 trillion per day. And while $10 billion bet is a massive amount, $1 trillion is much more. The truth is that Stanley and George saw the structural imbalance and made a killing from it. But they didn't break the bank. The truth is that the snake in the tunnel bit off more than it could chew, and this indigestion wasn't a matter of if, but when. And another thing, it's conventional wisdom that the devaluation caused a boom, making some call it White Wednesday, since it was followed by years of increased growth. However, the economies of similar countries that didn't devalue also experienced similar growth rates. So while conventional wisdom around the historic event is wrong, does it really matter? As I like to say when it comes to markets, you can either be right or you can make money. The choice is up to you. If you like this video and want to watch a fantastic documentary on how George conquered the markets, check this out.